Stocks mixed today as the market does close here. Here with us to talk about the takeaways of the trading day is Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, it is always good to see you.
Great to see you, Josh.
So Steve, it was interesting. Julie was mentioning, obviously, major averages were mixed today. It was, I thought, interesting to look at Uber today. Big name, loved on this. More than 90% of analysts say you should buy this, Steve, and it got wrecked today. I was just wondering, do you think there's any kind of canary in the coal mine? Is that suggesting anything bigger and broader to you, Steve, or no, that's Uber specific?
I think in this case it's Uber specific because I was traveling recently and I got all kinds of emails that, I was getting all kinds of discounts to take Uber for cheaper. And in hindsight, that was a 2020 signal to short the stock, but I didn't do it. I think what's going on now is actually the broader picture here, Josh, is we've had a number of stocks beat on their EPS numbers, but yet get whacked anyway. I think this is becoming the more important trend, is when you have a situation where 75, 80% of the stocks in the major indices are beating their EPS estimates, and yet they go down anyway because of some other factor. It's telling me that managements are getting very good at managing their analysts, but it's not. But now people are looking through them to see how they're managing their business. Think Meta, which got whacked; they beat on estimates. Think yesterday we had Palantir and Disney; they beat their EPS, and then they got hit anyway. Uber today. So this is becoming a thing where people are looking past. They sort of, it's sort of a necessary but not sufficient situation for you to beat on EPS.
It's interesting too, that people are sort of looking through, not necessarily buying the company line, if you will, but at the same time, are we seeing overreactions in a lot of cases? Some of the moves that we're seeing are quite extraordinary in terms of the size.
Yes, but it's always been a little asymmetric, right?
Yeah.
We typically don't see a lot of rallies that match the disappointments. The problem is we've kind of gotten used to them. We're expecting ARM, their last quarter, what were they, up 50%? And, we've gotten sort of spoiled by, let's say, the Nvidias of the world that beat and raise and then beat again and then raise again. And that's not necessarily normal. And so I think what happens is the markets do tend to punish disappointment more than they reward success on earnings. You're supposed to beat on earnings. You're supposed to do well.
You mentioned, Steve, Nvidia. Is that the next catalyst for the market we should be looking to?
Potentially, yes. And the reason why is, number one, that has been such the poster child for the rally. It's the AI darling, and this is certainly an AI-inspired rally. What worries me a little bit is what Mark Zuckerberg said in his conference call. Basically, I said he was saying the quiet part out loud, where he was saying, well, we're spending these billions of dollars on AI, but it may be years until we actually see the results of that. Well, if Mark Zuckerberg is saying that regarding Meta, which is probably one of the best positioned companies to benefit from AI, well, what chance do the rest of the companies have? And so does that mean, not that the trade is over, let's say, but does it mean that this part of the cycle is over? And I think about the internet in '99 and 2000, which proved to be everything that everybody thought it would be and then some. But it took a while longer than people anticipated for the internet to be the productivity, revolutionize the productivity that people thought it would. And so I wonder, that's my concern, is if and when does Nvidia start to peter out? Not necessarily go down, but just sort of stop the meteoric rise.